is comparing private credit to the 2008 subprime crisis, and I want to go through why that isn't the case this time. Fertilizer prices are skyrocketing. So we haven't seen an exit this big since 2008. We got a lot to cover tonight, including some macro updates. So most investors, they see the conflict in the Middle East as relatively short-lived, with the majority expecting the US and Iran to call a ceasefire by the end of April. Okay, so there's a 54% chance. There's a higher chance of that happening in May, 76% chance, according to a Deutsche Bank survey. We have to keep in account about 40 to 50 ships pass through the strait pre-war each day. We haven't seen any bulk carriers since March. This is going to be very bad for fertilizer, like we're talking about last week, but already fertilizer prices are skyrocketing. The New Orleans granular urea prices, they're the most widely used nitrogen fertilizer. They're up 89% since December. This is the highest level it's been since September 2022. Now, by comparison, the 2022 peak during the Russia-Ukraine war was 910 per short ton. Top exporters, China and Russia, they're also curbing crop nutrient sales. And this is tightening the supply further at the worst possible time, right before the spring planting season. So high fertilizer costs directly translate to higher food prices, threatening to reignite the agricultural inflation that we saw in 2022. Now, according to Goldman Sachs, they see a 12% market-implied US recession chance within the next year. It's not as doom gloom as we've been seeing online. Now, in a scenario where oil hits 170 a barrel, how big is the modeled shock here? US inflation would go up 1.6%. US GDP would go down only 0.3%. Okay. So that's for the US. Now, for UK, inflation would go up 1.9%. And their GDP would actually go down a whole percentage point, so 1.1%. Eurozone, basically the same number, 2% inflation, GDP is down 1.2%, so even more. Worldwide, we would actually be least affected by this. According to Bank of America, they're saying that hikes are most plausible if crude oil averages in the $80 to $100 a barrel range in 2026. Now, we're also seeing increasing evidence of oil demand destruction, especially in Asia, for jet fuel. Also, United Airlines, they're going to reduce scheduled flights by 5% in North America, not just Asia. Philippines, they are pushing for a 4-day week, and they're ordering officials to limit travels. Thailand, they're doing a similar thing. Bangladesh, Air New Zealand plans on reducing their scheduled flights by 5% as well. And German heating oil sellers to reduce sales on higher diesel prices. Markets may be starting to look beyond oil. Oil's influence on the S&P 500 may be fading here. Over the past 4 weeks, we've witnessed a deep negative correlation between crude oil and the broader market. Aside from 2 brief periods in 2022, this is the strongest inverse relationship has been in years. However, Wednesday's price action offered a notable divergence. Oil prices rebounded late in the day. The stocks and treasuries largely ignored the move. Wednesday broke the script. When oil recovered its losses in the afternoon, stocks and bonds didn't flinch. This suggests the oil panic is losing its grip, and the market is shifting its focus back to fundamentals, earnings, growth, and the Fed. If this decoupling sticks, the worst of the energy-driven volatility might be in the rear view. If we look at trading activity, we see that net call volume is at the lowest level since the April trade panic. During times when it goes extremely negative, durable lows have been formed in the past. It's worth watching this for any signs of capitulation. Now, speaking of Goldman Sachs, they put out their top-down S&P 500 target, and they're sticking with the 7,600 year-end S&P target here. Now, the institutions just staged their biggest exit in over a month. After 3 weeks of buying, big institutional players reversed course last week, selling off $11 billion in U.S. stocks. Now, that dragged the total market outflow to minus $9.3 billion for the week. The heavy lifting on the sell side happened in single stocks. We haven't seen an exit this big from individual companies since 2008. Hedge funds did buy a little. They bought 1.8 billion of stocks, and retail investors barely moved the needle with a 80 million sale. But the big takeaway here is the 16-week trend. We've now seen that 25 billion has left the market in that span. So the big money is clearly stepping back and watching from the sidelines for now. ETFs have accounted for 35% of trading volume over the past 3 weeks, peaking at 47% and setting a record streak above 35%. This reflects active shorting via ETFs to reduce net exposure. Levered end-of-day flows remain a key driver of volatility. Now, if we follow prior geopolitically driven risk-off events like we have now, we are now at the buy the dip stage of this scenario, according to Goldman Sachs. Pension funds are set to buy $14 billion in equities for a month to quarter end rebalancing. This ranks as the 75th percentile over the past 3 years in absolute dollar terms, and 97th percentile on a net basis. Now, since the beginning of 2020, the NASDAQ 100's forward PE is unchanged at 21.7. And if we zoom out, the index is up by 176% since 2020. But the PE hasn't changed, really. There's a valuation mismatch here. Now, let's talk about credit. The most common fear trade in 2026 right now is comparing private credit to the 2008 subprime crisis. And I want to go through why that isn't the case this time. So the narrative, the fear is private credit is a 1.7 trillion ticking time bomb that will crash the global economy. As far as banks that do have exposure, the most exposure is actually in Wells Fargo, okay? Now, let's see how much of the financial system this really is, though. Private credit is only 4% of the private non-financial credit sector. Now, in 2008, for context, residential mortgages were 45% of the private non-financial credit sector. So even if private credit defaults spiked to, let's say, 10%, and that, 10% default level is near GFC level, the drag on GDP would be a manageable 0.2% to 0.5%. I remember last year, private credit, this was a new blossoming sector that was blowing up. It was the industry that was making the most billionaires. And I will say a lot of companies like software as a service, so SaaS companies, a lot of those aren't doing well. A lot of those are getting eaten up by AI. But the fact that this is only 4% tells me this non-added panic level that we're seeing online. The thing is, tracking the macro data is only half the battle. And if you can't generate the right trades in a systematic portfolio, you're never going to be able to be profitable. So watch this video next. I'm going to show you the exact options framework that turns this market guessing into a game of probability. I'll break down the 5-minute index strategy I use to trade the broader economy rather than gambling, so you can build a portfolio that actually profits regardless of what the hawks or doves do next.